Hello everybody, welcome to our Kenanga's webinar. I want to welcome all of you to join this webinar. As you know, the best investment in the world is investment in your mind, because it not only, unlike investment in assets that give us finite return, investing in your mind can give us infinite return. Okay, so today we are very honored to have hosted Mr. Huat, who is the head of research of Kenanga Investment Bank, to talk about bargain hunting on post-COVID sell down. So of course, like the title suggests, today we're going to cover which sector is undervalued and which are some of the great companies that you can look at for potential capital gain. All right. So disclaimer, as usual, this webinar is only for case study. In no way that the speaker or Kenanga Investment Bank give any whatever we study is we already cover is only for case study. So if you decide to buy or sell anything, you do it at your own risk. Okay, the speaker and I are non-liable for all your financial decisions. So this is a disclaimer. And this webinar is brought to you by Kenanga and managed by Welford. So for Q2 this quarter, we have 2 more webinars for you. Last week we talked about is US bull market coming to an end, and this week we talk about the local outlook, market outlook in Bursa Malaysia, and then next month we will talk about technical charting. So you can ask the speaker any stocks or any charts, he will dissect for you. And in the month of June we will talk about the mining stocks. Okay, so this is the Q2 webinar organized by Kenanga, and allow me to introduce our speaker today. He is a veteran in the Malaysian capital market. Mr. Koh joined Kenanga Investment Bank as the head of research after 19 years in the senior management capacity in the fund management industry, where he held the position of chief investment officer. Now, prior to his fund management experience, he was an investment analyst with various sell-side research establishments, which include SG Research, RSP Research, Ong & Co, and CLSA. Mr. Koh holds an MBA from Melbourne University, Australia, and a Bachelor of Arts degree from Oxford University, England. As head of research, Mr. Koh is responsible for formulating the market strategy through carefully considered and timely analysis of macroeconomic and equity market conditions. So without further ado, let's hand the session over to Mr. Koh. Okay, let's get ready to learn what are the sectors that we can invest in right now. So Mr. Koh, you can share your slide.
Yeah, it's a pleasure to be back speaking to you all. Although I do wish that I can do this on a face-to-face basis, but we'll do what we can. As you know, we are living in extraordinary times. So yeah, thanks for making the time to listen in on Kenanga's view on the market. My presentation, I'll start off with some big picture stuff before I go into the sector and also some of the stock ideas. So let's kick off now, okay? So we started this year on a rather sort of nervous mode. As we all are aware, there have been 2 major events that has shaken the market by quite a bit. The first is that COVID-19, the impact of the virus, the widespread impact it's had globally has caused governments to resort to very desperate measures to try and contain the spread, imposing lockdowns in various countries, as well as introducing large stimuluses, scales of which we've not seen before. And the second event is obviously the collapse in oil price, and I think this particular one has quite a big impact on Malaysia, because given that oil-related revenue contributes, and I think in terms of during normal times, oil-related revenues is actually about 25 to 30% of the government's total revenue. And the government had mentioned that every $1 US dollar change in the price of Brent actually impacts the government revenue by 300 million. So with Brent is now at low 20s, but if you think that it will stabilize at 30, then we are talking about a drop of $30 from the base case of 60. And that's going to hurt government's receipts by something like 9 billion ringgit. So that's quite a bit, because that's about 0.6% of GDP. So in a way, both these are kind of related, because oil had been impacted by both sides of the equation. On the demand side, obviously, the lockdown that we are facing has caused much less energy consumption. So basically, people are not buying energy oil like they used to. So demand fell sharply. And also on the supply side, Russia and the Arab countries, back in early March, they failed to agree upon a cut in supplies. So you have, excessive supply on the one hand, and then you don't have demand on the other side. So it's really a double whammy, and that's caused a lot of disruption to the market. Right. So yes, I was mentioning the two major events that have shaken the market very badly, right? COVID-19, as everybody knows, that's led to governments taking very drastic actions in terms of introducing stimulus packages to help support the economy that was free falling, and also oil price. Oil price has a big impact on Malaysia, because we are a net exporter of energy, and oil price during normal times would have contributed something like 25 to 30% of the government's revenue. So the fact that oil price has fallen so much has a very big negative impact on the budget, which I will elaborate as I go along. Okay, what happened during the first quarter was pretty sort of unnerved us quite a lot. Big part of our job as analysts is that we have to keep monitoring macro developments and how it impacts the economy, and down to how it impacts corporate earnings. At the end of the day, valuations of companies comes down to how well corporates do in terms of earnings delivery. So it does look pretty bad, but through the course of the first quarter, I've lost count of the number of times in which we had to downgrade forecasts. So anyway, I must confess, when we started this year, we were pretty bullish. We were actually looking at the target for the CI to reach about 1,700, on the view that this 2020, this was back in early January, right? 2020 would be a year when the KLCI EPS growth finally turns positive. For the last 5 years or so, the trouble with Malaysia had been that our EPS growth had been very, very weak. In fact, there have been many years where EPS growth was declining. So we felt that this year would be a change, because we were confident that plantation CPO price would turn around. Late last year, no one would have thought that oil price could have turned negative. Banks bore the brunt of OPR cuts, and we thought that the banks would sort of turn around this year, but none of those are happening. In fact, the first phase of the oil price crash has caused us to reduce our projections, and then subsequently, when the COVID started the year fairly harmless, we didn't think there was going to be a big impact. We thought that it would be a bit closer to what SARS would be, but it obviously was a lot more worse. It was more fatal than SARS in the sense that the spread was faster and wider, and it caused almost every government in the world to actually having to impose, lockdowns, some form of lockdowns anyway. So basically, economies came to a halt, and as a result of all these observations, we reduced our GDP growth. We started the year expecting that Malaysia would expand 4%, and as the quarter progressed, we downgraded along the way, and now our forecast for the GDP growth in 2020 for Malaysia is a contraction of minus 1.9%. So effectively, we're calling a recession, and the contraction will be pretty much a first half event. We think that there will be a turnaround in the second half. It will be a feeble one, but for the full year, we're looking at something like minus 1.9%. And how does this compare with what the government is saying? Okay, the latest number we have is from Bank Negara's annual report, which came out about 2 weeks ago. In that report, Bank Negara says that they were expecting the GDP for 2020 to range between minus 2% and 0.5%. So our forecast is at the lower end of that range. But suffice to say that there will be a contraction, especially in the first half. I think this particular quarter will be the worst. And all these numbers, right, the revisions and so forth, comes amidst the government's effort to try and contain this sort of free-falling economy. What they've done, I think, is quite commendable. They did what had to be done in terms of providing support to the economy, because I think a lot of what they're doing is premised on the expectation that this crisis is going to be, probably a transitory affair, maybe 6 months or so. But a lot of things can go wrong in this 6 months window. So they have to come up with measures to prevent things going badly wrong within this 6 months. So it's really a measure to try and tie us over this difficult period. And they came out with actually 4 stimulus packages totaling something staggering. 260 billion was the sum that they introduced. 260 billion is a sum that we've never seen before in terms of stimulus, and that's about 17% of our GDP. So that's huge. And out of this 260 billion, right, actually 100 billion involves what we call loan moratorium provided by the banks. And these loan moratoriums are basically indulgences where banks give to, especially to the small and medium-sized companies and the individual borrowers, the retail borrowers, because they see them as being the vulnerable sectors. And also, the moratorium is open to larger corporates. If they need help, then they could opt in. So that's about 100 billion to try and support the economy. Basically, telling financially challenged borrowers, hey, okay, we know you're having sort of cash flow stresses. You don't have to service your monthly loan for the next 6 months, and after September, then you can resume. And it's with that view that hopefully things will have settled quite a lot by September, that our economy can regain its composure and sort of progress more normally. So there's 100 billion there. And then 50 billion is really in the form of credit guarantee, especially for the SMEs who need working capital, and then to finance it, they have to borrow from the banks, and banks will be more willing to lend if it's guaranteed by the government, for example. So 50 billion is in that form. And then another 50 billion is actually people's own money, which is 10 billion is actually from the 4% reduction in employees' contribution to the EPF. And then there's a 40 billion whereby individuals like you and me who have EPF account can actually withdraw 500 ringgit a month for the next 12 months. So that's 50 billion. So all in all, 200 billion is actually outside the government's funding. The amount that is actually funded directly by the government comes up to 35 billion only. Anyway, 35 billion is still quite huge compared to what we used to in the past, because 35 billion is about 2.4% of the GDP. But what I want to highlight here is out of this 35 billion, right, 10 billion is basically cash handouts in the form of Bantuan Prihatin Nasional. For the B40s and M40s, they get 10 billion in total. These are money in the pocket. Then there's about 14 billion in the form of wage subsidies for employees who work for financially challenged SMEs. The government, upon application, will subsidize their wages, so as to make sure that they don't suffer any wage loss or whatever. So there's 14 billion. So 14 and 10, 24 billion there, which directly impacts the man in the street. Then you have the 50 billion. Remember, I talked to you about the EPF withdrawals and so forth. So there's 74 billion. So there's 74 billion of firepower there to actually help the person, the common person. And I think this ties in with my Kenanga's investment team that in difficult times like these, where would you put your money in the stock market? I think if you build a portfolio, you don't want to put all your money into some aggressive cyclical stocks. You may want to apportion a part of your portfolio into something defensive. So what's defensive at a time like this? It is the essentials. Companies that deals with essentials like food, for example. Things which are so basic to your daily sustenance. And you can argue that at a time like this, all these subsidies and bantuan or whatever you call it are actually money in the pocket for people who are lucky, who will still have jobs, right? It's additional income for them. And for others who are less fortunate, maybe it's a replacement for incomes lost. But both sides are probably, I think it would be fair to say that most people are very cautious at this time. So even with extra money, they would probably not want to spend very much. But essentials like food, basic clothing, yes, I think at least it helps sustain that. So in this space, we like, in fact, we're recommending that since some of these stocks have fallen so much, do go ahead and buy stocks like F&N Holdings. They deal with very basic products, dairy products, food stuff. QL Resources, they deal with basically food, fish surimi paste, for example. They also deal with poultry, farming, which means eggs and chickens. And also they have palm oil as well. And don't forget, they also have Family Mart, which is a highly successful, convenience store, which isn't subjected to closures during this MCO period. And another name which we like a lot would be Power Root. They deal with coffee, which can be bought even during MCO periods. And I'll elaborate a little bit more about these names later. But yes, back to the economic side. Yes, as I mentioned, we are in contraction mode. The other thing that concerns investors is the stresses that the government is facing in terms of budget deficit. Even under the previous government, we've been very worried that our borrowings are so high. Our ratings may be downgraded, and it increases the borrowing cost of the country and that sort of thing. Yes, because of the stimulus, the 35 billion that had to be spent, that's necessary, you can't run away from a larger fiscal deficit. When things were hunky-dory, we started this year thinking that we'll probably see the budget deficit at 3.7%, which is something very manageable. But with 35 billion having to be spent by the government, and if you assume that all the 35 billion will be borrowed in the market, in the bond market, then you're going to widen the budget deficit from 3.7% to something like 6.7%, and that's pretty huge by our standards. But 6.7% was something we've seen before. 6.7% GDP budget deficit was the deficit that we suffered in the last recession of 2009. So that was, but although that at the point in time, our federal government debt was only about 50.8% compared to 58% now. So, we have less room to maneuver. But having said that, we don't think that the budget deficit will be as bad as 6.7%. We're actually looking at 5.6% because, part of the 35 billion will come from sources like maybe more dividends from GLCs, especially Petronas. Remember, Petronas is actually a very strong company financially. They've got a net cash of about 80 billion. So even with oil price where it is now, they do have pockets that are deep enough now. Also the other avenue would be for government to reallocate some of the cost savings. For example, with Visit Malaysia year out of the way, those that was allocated for it could be used to help fund this 35 billion, things like that. So it's not so bad. I mean, our budget deficit will balloon, but probably we think it's going to be around 5.6%. I think more importantly, what about the market? EPS will contract obviously for 2020. Okay, let me tell you that in 2019, right? This for the FBM KLCI. For those who may not know, there are 30 stocks represented in the KLCI, and this is basically the main barometer of the market. And these are your so-called blue chips, the big names, lah. And in 2019, collectively, they produced 95.1 cent per unit, as a measure of earnings per share for the KLCI. In 2020, this year, we thought that earlier on it's going to be able to make 102.4 cent. But because of what's happened, we've cut that expectation down to 87.2 only. That's a 15% downward revision to earnings. And that is an 8.4% contraction to EPS. So that's how much corporate earnings will be hurt. In 2021, we are assuming that 2021 COVID will be a thing of the past. Economy, corporates will sort of return to more normalized mode. We expect to see a rebound of earnings back to 98.2 cents per share. So therefore, what I'm effectively telling you is that we are expecting a rather V-shaped looking recovery, right? That's our base case. And your question is, with EPS shrinking, 8-9%, should we be excited about the market? Question is whether, well, remember the market has also fallen quite a lot. Has it reflected that situation of 8 to 9% contraction? So that's a question we have to ask ourselves. Okay, just to give you a sense of how much we've fallen, this chart shows you the various indices and how much they've fallen year to date from 1st January this year to yesterday. Now, the KLCI has fallen 13%, price change down by 13%. At its worst was nearly 20, right? That was on the 19th of March, but it's rebounded from there. Small caps is down 25%. The mid caps is down 20%, and the Sharia index, the halal stocks, is down 11%. So that's give you a sense of how much of the market has fallen. And fund managers like to get a sense of how cheap or expensive the market is by looking at this PE ratios of, in this case, the KLCI. Now, this chart shows you where the KLCI is in relation to 12-month forward price to earnings ratio. The straight lines here, the yellow line I'm showing you now is the PE of 15.9 times on 12-month forward earnings. That is the average price to earnings ratio measured over the last 5 years. So you can imagine over the last sort of 60 months or so, what was the average PE? So the answer is 15.9 times. 15 times is where we consider a low PE ratio. It has happened before in the past, obviously, but it's a rare occurrence. 15 times is what we call 2 standard deviations below mean. It's like a sort of 1 in 10 occurrence, if you do a sample. So you look at the blue lines, right? At its low, this low of 1220 happened on the 19th of March. It is well below even 2 standard deviations below mean. It was very cheap at the point in time. Now from 1220 we rebounded. Today's close was about 1380, and it falls here, which is about 15.3 times, 15.2 times. So 15.2 times is about 1.3 times standard deviation below mean. Still cheap. When so I suppose the average would be 15.9 times now, but we are now about 15.2, so it's still less than the average. But the question that's being asked is, okay, let's not look at stock first. Let's look at the broad market, right? The KLCI. Where should it be? Where should it be at the end of this year? Now, if the question is where is the market going to be at the end of this year, 31st December 2020, you shouldn't be worried about what's happened now this year. You might as well say 2020 is a lost year, but let's look at 2021. If we are right about 2021, delivering EPS of 98.2, and if you're worried, not very confident about the market, okay, you apply 15 times PE to that 98.2 cent per share for 2021, then the CI should come to 1463. That's our target KLCI level. 1463 based on 15 times PE applied to 98.2 cents. Right. Obviously, you say, oh, 1463 is about 6-7% from where we are today. That's kind of attractive. So I'm saying, yeah, with the upside there, buy now, But obviously, the journey from here to there, to the end of the year, could be a very rough one. There'll be volatilities, new bad news coming through, and there could be victims along the way. So as an investor, you have to be able to tell which stocks are going to survive, which stocks will not. Obviously, then you have to do the homework. Okay, so that's an important thing, to be not to be overly aggressive at this point when there's still many unknowns, right? But I'm saying that if one believes that this thing will come to pass, you have better days ahead in 2021, you can buy now, but choose your stocks carefully. Okay. Okay, just to give you a picture of what we expect this year. As I say, the EPS for KLCI will fall 8.4%. What's causing that fall? Okay, now this chart tells you that, give you the answer. Banks a big component of the CI. They are 36% in terms of weight, but in terms of profit, they contribute half the KLCI. We are projecting a challenging year for the banks. We think EPS for the banks will shrink by 11%, and therefore, as a contribution to the KLCI is going to be down 5.5%. So, you see, so it's 5.5% contribution to the 8.4% contraction. So a lot of it comes from the banks. The other culprit is the oil and gas sector. Here you have stocks like MIC, Dialog, Petchem. Yeah, these are some of the major ones. Oil and gas, as you know, is a victim of the oil price crash, and it's only reasonable to assume that Petronas will cut its capex, and therefore that will affect the jobs for the entire value chain. But where it hurts most would be those guys in the upstream side, but less so on the downstream. But not to say that the downstream people will be unaffected. They will. Probably margins will be less, and things like that. But the upstream, they may suffer project cancellations, project deferments. So yeah, we are seeing earnings contraction for the oil and gas. Gaming, there are two names here: Genting Malaysia and Genting Perak, and they are one of the worst affected companies in Malaysia. Virtually every casino that they have globally are shut. They had to resort to salary cuts, as was announced 2 days ago. And in particular, for Genting Malaysia, they did a very, very bad investment in Empire Resorts. And they already made one cash call a couple of months back. And that unit is still bleeding quite a bit. So they probably have to fund another round of cash calls. So very, very bad for both the Gentings. The only silver lining is really Plantation. And I hope that can hold, because Plantation, we are looking at a contribution of 2% growth, so it offsets the negatives. Why we think Plantation will grow? Because last year was a very bad year for Plantation. You recall that CPO price fell as low as 1,008 for a while. The average of last year was 2,002. This year, my colleague who covers Plantation has forecast an average price of 2,005. So it's still above what it was last year. So this is one of the few bright spots. But in total, we are expecting a down year in terms of earnings. So I've given you an idea of where we see the market ending up this year. But equally important is, if things gets rough, how low can the market go? Now, to try and find an answer to the question, we try and look for guidance from the experience of the last recession. Our last recession was in 2009. Remember the subprime crisis that almost paralyzed the entire banking system in the US. And yeah, we bore the brunt as well. I mean, there was a contraction that year. And markets fell sharply. At the lowest point in 2009, the price to book value of the KLCI reached a low of 1.2 times. Okay, this other line here is 1998. That was an even worse crisis, but I don't think we'll go there this time. But 2009 is probably a good reference point. So as I say, the lowest point was a price to book value of 1.2 times. While I did this chart, it was on the 19th of March. Quite fortuitously, it was also the lowest point of the year. This point here is 1220. And by fortunate coincidence, the 1220 also represents 1.2 times price to book. So last month, we were really at the bottom, fundamental floor. We actually revisited what we experienced in terms of price to book ratio, almost 10 years ago. So what I'm trying to tell you is that fundamentally, I'm confident to say that 1220, which represents a price to book of 1.2 times, is a fundamental support, a very good fundamental support. And 1220 is a PE multiple of 13.6. Remember, I told you that the average was 15.9 and the 2 standard deviation low was 15 times. This is 13.6. So it's really, really low. Okay. We move from price to book from sort of fundamental to something more technical. For people who likes technical, I want to show you a Fibonacci retracement chart. This is also a chart taken on 19th of March when the CI fell to 1220. Now, there's a retracement. There are various major lines here. One of the major lines is a 62% retracement. And 62% retracement is a 1238. 1220 is in the vicinity. So one can argue that 1220 is also a major technical support. Okay. Now, can it get lower? Yes, it can. The next Fibonacci line, a major line, would be 76% retracement, and that line corresponds to 1038. If you ask me how likely that happens, I would say unlikely. It would take something really bad to break 1220 to test 1038. Or I can imagine that bad news would be in the form of a bank in distress, because almost every big crisis always kind of the peak is a bank screaming for help, banks having to be recapitalized and so forth. But I don't think we will see the scenario unfolding this time, because I think banks are much better capitalized in a very strange but fortunate way. 2009 was a lesson learned. Governments became more, how do you say, vigilant about the bank's balance sheets. They made banks strengthen the capital ratios and so forth. So we are facing this crisis from a position of strength as far as the banks are concerned. So even, okay, was it 2 days ago, we heard about Hin Leong oil trader that went bust, and CIMB had 500 million exposure to it. It's quite a big number. But remember, CIMB is a big bank. CIMB, I just checked, they have a core equity tier 1 capital of 41 billion. So even if you write down 500 million, it's only 1.2% of their core equity tier 1 capital. 1.2% only. And CIMB, with the kind of capital they're holding, their regulatory ratio, the CET1 ratio, is 12.5%, which is well above the regulatory minimum of 8%. So it'll take a lot of Hin Leongs to actually shake things really, really badly. I don't think banks will be badly hit. We'll touch wood. But so far as far as I can see, I don't think that's going to happen. Okay. The other thing I want to highlight is that foreigners don't really like Malaysia for many years already. They've been selling Malaysia. I think a number of reasons. In the past, it was because Malaysia used to be a big component of emerging markets, but since China became more and more influential, China has been aging out a lot of other emerging markets, Malaysia included. Then we had the oil crisis in 2014, 2015. Then CPO prices kept coming down. And then there was a shock in GE14, that sort of thing. So a lot of bad events, one after another. So net foreigners have been actually selling down our market quite a bit. And this chart, I want to show you, these are quarterly outflows of foreign holdings in Malaysia. And the latest quarter, the first quarter of this year, because of the crisis, right? Foreigners have withdrew something like close to 8 billion in last quarter. And we've not seen such a scale of outflow for a while. The last time we had this kind of size in terms of outflow was second quarter of 2018, when the unexpected change in government took place. So yeah, and the selling has been quite a lot, to the extent that the share of foreign ownership in Malaysian equities has fallen to something like 15.5% among the big caps, and this is a multi-year low. This is excluding strategic holdings. And yeah, so it's actually pretty low already. So foreigners are pretty dry in terms of their holdings. So that's can be seen in a positive light. A lot of selling has been done. What are we looking at to get a sense of the turning? What catalysts could actually help the market up? Obviously, it would be if people are confident that this COVID-19 problem is finally contained. So for that, you just have to follow the progress of new cases, and the market that I think holds most importance would be US. Asia is kind of like in the past already. It started in China. China is having a bit of a relapse. What do you call it? Secondary impact, but the intensity is much less than the first impact. So as long as that's the case, then not much to worry about. Italy also, it's heartening to see that it peaked around, I think it was March 19 in hindsight. So the latest numbers show that the number of new cases have actually fallen quite convincingly. I think we were past the worst for Italy. US is still hovering around. I would say US is plateauing. The peak was about 37,000 new cases back in early April, but the last sort of 10 days or so, we've seen quite a number of days where it was below 30,000. So that's very encouraging. So things are looking as though they are stabilizing, and it's just a matter of time. Hopefully, there'll be no big resurgence. It's a matter of time when President Trump will probably restore things to normalcy, and get the economy going again. So once that happens, I think it'll be very, very bullish, right? You need that kind of spark. What further responses can the government give to, in case things do look worse? There are some bullets left. For example, statutory reserve requirements, they've cut by 1% so far this year, from 3 to 2. At its worst, in the last recession of 2009, it was down to 1%. So there's still 1% headroom left there. OPR, overnight policy rate, we are now at 2%, 2.5%. It was cut 50 basis points in January and March. So it could go down to 2, which was where it was in the last recession. So there's a 50 basis point bullet there. And so all that will help to, if liquidity is needed, they can cut it there. And then hopefully when things do normalize, when this MCO is lifted, what can be done to jumpstart the economy? Well, Bank Negara in his report say that if the construction capital spending can be restored to 15 billion this year, it will lift GDP by 1%. Hopefully that will make the number less negative. And they singled out MRT2, LRT3, and Pan Borneo Highway, which are 3 ongoing projects. Although I suppose the pace is less, even before COVID, but now with MCO, they're totally stalled. But once these come back, it can, add quite a lot of momentum to the economy. And construction is very useful as a means of jumpstart, because they've got high multiplier effect. They have linkages to other industries as well, like the building materials, energy, transport, things like that. And I think it employs something like 1 million people in this business. Post-recovery, GST maybe will come back, but definitely not this year, because you don't want to impose GST when there's a recession. Maybe when things are bad. But I think it's fair to say that there'll be payback time, probably starting next year when things normalize. Now, GST is very important because by switching from GST, which is a more broad-based tax system, to SST, the government has actually lost something like 22 billion in revenue. So reintroducing it at 6%, if 6%, can add quite a bit to government's pockets. So let's see whether it happens. If it does happen, it'll be next year. Okay, sectors that we like, or rather sectors we have overweight recommendations on. We've seen the number of sectors in the overweight category grow by quite a lot, because not so much because we like a lot of them, but because prices have fallen so much. In fact, prices have fallen much more than the rate at which we cut the earnings forecast. So it became cheap in that sense. But the catalyst might be still not there. I mean, left wanting in terms of catalysts, but they are cheap. The cheap ones that we can identify are definitely the banks. There are no growth this year, obviously, but in terms of price to book, they are very, very low. Construction is the other one, very low price to book. Gaming, we don't like Genting and resorts, but share prices have fallen. Genting Malaysia is down to 190 at one point. If you hold on to the view that casinos will reopen and things will normalize, then gaming is very, very cheap. Media here, we like Media Chinese because Media Chinese, right? The cash per share is 16 cents. Their net cash company, dividend yields of 7%, is trading at share price about 19 to 20 cents only. So great value there. Property, no catalyst, but is trading at 0.3 times, 0.2 times price to book. Very, very cheap. I suppose the last three sectors are sectors which we really genuinely like at a time like this. Rubber gloves, obviously, rubber gloves is one of the few, if not the only sector that. Okay, I would say rubber gloves is one of two sectors that promises growth. Not only are our rubber glove manufacturers getting more orders because of increased usage in medical gloves, but also I think even post-COVID, there'll be greater attention towards greater hygiene and even masks. So it's a more lasting impact beyond the current crisis. So gloves, we like as a sector, is growing like 15 to 20% per year over the next 2 years. And yeah, technology is the other one we like. The names that we follow and whom we've spoken with recently conceded that yes, earnings will be challenged this quarter, especially. But it's not a case where orders have been cancelled. It's actually a deferment or a backlogging of orders. So when this COVID is finally contained and then things resume to normal in terms of logistics, deliveries, and so forth, technology can come back very, very strongly. So it's a sector we like very much. Telecommunication is defensive in the sense that its product is unaffected by what's going on. In fact, the fact that I'm doing this webinar with you, is testament that there's more usage of their products at a time like this. So in a sense, it's very, very stable and safe. Consumer we like as well, but it's a bit of a mixed bag. You have to be selective. You go for the consumers which deal with basic food stuff, things that are needed as daily sustenance. Definitely not your cars or luxury goods, obviously, because retail outlets are all closed. And yeah, maybe I'll just end this session with some elaboration of some of the names we like. I mentioned Power Root, right? Our target price is 265. It's trading around 220, maybe at this point, but it gives you a dividend yield of 5 to 6%. So the total return can be as high as 15, 16%. And it's a net cash company and it's gotten last 2 years they have restructured their distribution arm, the distributors, such that they are now cost efficient and more effective. And they've also been able successfully diversified their markets to such that now exports contribute about 50% of total sales. So the weakening of the ringgit is now 435, 440 to the US dollar. It's actually positive for this company. QL is something we like very much. It is, well, I must warn you that this company is trading at 50 times PE. But good things are that they are expensive for a very good reason. QL is defensive in the sense that they have a very resilient earnings base. They're I would say 4 equal legs. One is the marine products, basically fish paste, fish balls that you can find in supermarkets under the Mushroom brand. They also, I'm sure in supermarket chains you've seen QL eggs. They deal with eggs and also broiler chickens, and then they also do palm oil. Yeah. And the fourth leg would be Family Mart, which is highly successful. They started Family Mart in November 2016, and in less than 4 years, they've started to break even. There's excellent news because I think their original target for breaking even was something like 2022. So they're breaking even far earlier than what they projected. And I remember this stock debuting in those days, in the late 90s. It was called the Mestec, right? It was like a second board, humble lowly stock. And now 20 years later, right, it's grown so phenomenally. It's now actually number 29th largest stock in the KLCI. It is just a testament of how well managed this company is. F&N, we like, I think partly also because 70% of its operating profit is exposed to Thailand. Before COVID, the Thai market was fantastic. The Thai baht was great. I think things were going very well for the country. I think politics have stabilized a lot more, a lot already. So I think once this COVID thing comes to pass, things will be better for F&N. And they are really a household brand name in dairy segment in Thailand. And also recently they publicized that they were very interested to go into the upstream fresh milk business. In fact, they were trying to buy some dairy farms up north, which unfortunately was scuttled last minute. But that doesn't end their ambitions to actually go upstream. As you know, a large part of our fresh milk is actually imported. So there is commercial import substitution opportunities. And I think they're looking in the right place to expand their business. And for a company that has a brand name of F&N, right? We reckon that it's worth 30 times. It's worth paying 30 times PE for this company. We should value the company at 35.20. So it's a great name to pick up. Technology, yes, technology is something we like a lot. And there are 3 names here we want to recommend: MPI, Kesem, and DNO. One thing that's common for these 3 names is the fact that their products actually goes to automotive, basically car making. especially for KSM and DNO. 90% of their revenues comes from providing electronics, semiconductors to the car industry in Europe and also in China. MPI is about 30%, but MPI is also a beneficiary of trade diversion. They've expanded, invested successfully in Suzhou, where they are reporting very good orders from Huawei. Huawei is now adopting a more inward outsourcing policy where they're giving more orders to local players. And so MPI in Suzhou is benefiting from that move. Besides exposure to a growing automotive demand. Now, I think the story that's going to drive DNO and KSM is recovery in car sales in Europe. Last year was a bad year for Europe because of fall in car sales. Because the European Union they introduced more stringent environment emission standards. So as a result, the buyers and also industries were modifying their cars or waiting for cars with which could pass more stringent emission standards. So as a result of that sort of waiting game, right, car sales fell. But now that's 1 year past already, so we are past that now. We observed that from October onwards last year, before COVID obviously, October, November, December, there were 3 consecutive months of recovery, positive growth in car sales. Unfortunately, COVID had to hit, and so we went back to negative. But we think that this is momentary. Car sales will come back in Europe, and that will benefit DNO and KSM immensely. As you know, because of more stringent emission standards, the share of electrical vehicles as a percentage of car sales is going to rise. Not only that, even in traditional cars, right, you observe that there are more and more electronics in cars, internal as well as external, especially lights and so forth. Lights are becoming very, very smart, and very sophisticated. And DNO is one such company that provides those things, right? And DNO is actually world class in terms of capabilities. They compete successfully against people like Osram, yeah, so that's the reason why we like it. And they're trading not expensively. For DNO, it's only 15.6 times this year's price to earnings ratio, and also for MPI, it's trading at less than 12 times. Okay, I'll end this. Yeah, I think we're nearing time already. Last slide. It's interesting to note this because every 6 months, right, FTSE Russell, the manager of our index, the KLCI index, right, they will review the makeup of the 30 stocks, and the next review comes up in early June, and it seems to me that in this next review, in a month's time, 2 stocks looks very vulnerable towards being kicked out. Those 2 stocks will be Malaysia Airport Holdings and AMMB. Now, Malaysia Airport Holdings has fallen in terms of size, market cap, to 40, and AMMB has fallen to 34. Now, the rules of the index is such that if that component size falls below the rank of 36, it will be removed, right? And if airport is removed, what goes up is either KLCC Property or Telekom Malaysia. And it so happens that Telekom Malaysia is one of our topics as well. So if AMMB, for example, and Malaysia Airports goes, then Telekom Malaysia and KLCC Property will be up. Now, the reason why this is important is because fund managers pay a lot of attention to what goes into the index. There are a lot of passive funds, index-linked funds, who will just replicate the index. So whatever goes in, they'll buy. Whatever goes out, they'll throw. Even active fund managers, right? They will somehow they may not want to take too much benchmark risk. So even on stocks they don't like in the index, they will have some exposure. So what I'm trying to tell you is that to be in the index is a big plus for any company. And I want to highlight QL, as I say, is number 29. It will not make it this year, but I won't be surprised if within 2 years it'll be there. So there you go. Yeah, this is the top 10 picks that we have: DNO, FNN, Harta, KSM, Media Chinese, MPI, Powerroot, QL, and Telecom Malaysia. I think I've exceeded my time allocated, so I think I'll end there. Thank you very much for listening.
Okay, thank you, Mr. Koh. So now the time for our Q&A session. So if you have any questions to ask Mr. Koh tonight, please write in the question and answer box, not in the chat group. The chat group got too many comments, so I will not be able to see your questions. Okay, please write in the question and answer box in full sentences so that we can really understand what you're trying to ask. Okay. So, Mr. Koh,
Yeah.
the questions that I want to ask is, what do you think about oil and gas stocks such as Dayang, Charimin, Armada, Valesto? No, are these oil and gas stocks worth investing now?
Okay. Yeah, that's a very relevant question. Since oil price, oil crisis in a way. If you take the longer term, I'm okay with oil and gas. I don't think, for example, look at the big picture. Oil price, WTI falling to negative 37 the other day, is just purely technical and is unsustainable at the levels, right? I think we are going through a situation where oil demand supply is adjusting to a new equilibrium. As I say just now, the problem really is that this lockdown in the US and in parts of Europe has caused fewer cars to be driven, planes to not fly, so they're not consuming fuel, and inventories are high. There's no storage left, so that's the problem. The demand is not there, and I read a report that suggests that this COVID lockdown thing, right, has actually removed something like 30 million barrels a day from the demand side. Now, in early April, the Arabs and the Russia finally decided to cut by 10. So you still have 20 million surplus. So 20 million, surplus in supply, right? So I think if you look at it in those terms, you have to shut off the production in the US. So that's why we had that negative price the other day. But going forward, I think it's important for the resumption of activity to normalize. Maybe not to the level pre-COVID, but still better than where we are now. Once these lockdowns can be eased, right, demand will come back, and that's where prices will go back, probably closer to, in terms of Brent, closer to 35 maybe. WTI closer to 20 or thereabouts. So prices will come back. The important thing is that if you buy any oil and gas stock, you don't want to be holding things like Hin Leong, for example. I know Hin Leong is not listed, but I mean any listed companies which you think is going to go under if things don't turn around within 6 months. So what I'm saying is that the big picture is that oil price will improve. I'm quite sure by the later part of next half, I think we can breathe easier. But you have to be very selective as to who you buy. Avoid those which are very highly geared. For example, I worry for things like Bumi Armada. They are like 2.5 times geared. Their current ratio is something like much less than 1. So I'm not sure whether there's going to be a liquidity problem. The safe ones will be MIC, for example. Petchem, their net cash. Dialogue is very safe. Yinsen, maybe. I think Yinsen will survive, obviously, but they may suffer like project deferments and therefore subjected to quite a bit of a rough ride. So you have to be very selective. I would say yes, generally you buy, but make sure you avoid the dangerous ones and make sure that you can hold for at least 6 months.
Okay, thank you so much for wonderful sharing on the oil and gas sector. So in terms of banking sector, what do you think for long-term investment, like 2 to 5 years? Do you see them performing well?
Okay, in the short term, if you have to buy banks, right, the best names would be like Public Bank. It's come down a lot. And I think this is a safe bank. They are very well capitalized and they don't have much exposure to the dangerous sectors like oil and gas and so forth. Maybe the more dangerous ones would be, say, Alliance Bank, which have large exposure to SMEs. Even before COVID, they've been reporting higher credit costs and also making provisions for some of the loans that went bad. I mean, not just in terms of London Biscuits and other corporates, but also I think some of the mortgage books also have been impaired. So yeah, I think Alliance Bank is probably the opposite of the spectrum. But suffice to say that I think all of them will survive because they are well capitalized. So in the pecking order, if you have to buy, my top pick would be Public Bank, followed by Maybank and RHB. RHB, I think I just spoke with them yesterday. They think that they'll be able to maintain dividends, so that's good. This moratorium that they are providing, right, is actually for the rest of this year. I think banks will be okay. Because by providing 6 months moratorium, basically you're saying there'll be no, how do you say it? The growth in impaired loans will be limited because, loans which are unserviced during a moratorium cannot be considered a non-performing, right? So in that sense, your gross impaired loan ratio will not sort of balloon, to a level that frightens you. Net credit costs, yeah. Credit costs will go up because there'll be obviously stresses, within some of the borrowers, but manageable. Loans growth is, in normal times is 4%, so we'll be lucky to see 2% this year. Yeah, banks will report lower earnings, but definitely not losses. So in a sense, you can buy banks, but choose a good one. Yeah.
All right. So your recommendation was Public Bank, Maybank, RHB. Okay. Yeah, if I got it correctly. All right. So now there are many questions in relation to the technology sector. I think just now you covered about KSM, DNO, and also MPI. But what about 5G link stocks? Or maybe some AT related, such as Vitrox, Penta?
5G linked. 5G linked would be okay. The names that spring up would be Inari. They do those radio frequency modules. The radio frequency content in 5G handphones will be a lot more, so they benefit in that sense. The other 5G beneficiary would be actually TM, Telecom Malaysia, because they have the widest fiber optic network. And if when Malaysia moves to 5G implementation, right, no matter how the landscape evolves in terms of uh, ownership of 5G infrastructure, the traffic will have to end up in Telecom Malaysia's asset, the fiber optic. So they will benefit in terms of getting revenue from that traffic flow. So Telecom Malaysia would be a beneficiary of 5G development in Malaysia. Yeah, I would say it would be very much Inari. I would top my list.
Okay, so Inari lah.
Yeah.
Yeah, so right now we are hovering about 1,300, near about 1,400 points. So do you see that the low of 1,200 points will be tested in the coming few months?
Okay. Well,
Especially when the Q1 result are out lah.
no, I think Q1 results, a lot of people, Q1 results won't be too bad because you're talking about March quarter. Remember, MCO started March 18. It's Q2 that's more worrying. But then again, you see, Q2 results will only come out in August, right? Now, by August, hopefully, we would recover in the sense that people will be back to work, no more work from home. Restaurants will be open. People get a bit more confident. So by April, when the lousy results come in for the June quarter, people will say, this is the past. Let's look to maybe fourth quarter or next year. So maybe the results might not be so much of a concern if by the time we hear about the results, we could see a better future. Yeah. So I'm saying 1220, I'm not saying it won't happen, but if it does happen, 1220 is a very strong support because, as I say, that was in terms of valuation, that was the last low that we saw in 2020 in 2009. But I got a hunch it will not. It will come back. The market will pull back, but it won't be as low as 1220. That's my hunch anyway.
Okay, you still feel that 1220 will hold, huh?
Yeah, I think it will hold.
Okay, awesome. So how about high dividend yield counters? What are your thoughts about them?
High dividend yield counters, then you have to look for, I think a number of consumer names gives that. As I say, just now I highlighted Powerroot, net cash, Media Chinese, net cash, 16 cents per share. Its share price only is 20 cents. So, 4 cents, for 4 cents you get, the press business and they've got the tourism business as well, which will come back when this COVID thing is over. They can pay dividends of like 7% yield. The traditional dividend stocks which we used to like REITs, right? That worries me. They might not be able to deliver the dividends that they used to, simply because a lot of them are under stress to maybe waive rental or keep discounted rentals for their tenants. So I think the universe of high dividend yielders could be a lot more limited. But yeah, you could look harder, I suppose. Like I say, MCIL, Powerroot, and then actually the banks give quite good dividends. Because they're also very well capitalized. That's why RHB, when we spoke with them, they say, they don't find there's going to be, at least for now, no major liquidity issues. They are well capitalized. They can actually maintain dividends that was paid last year. So yeah, public bank, I suppose, will also be able to continue delivering dividends.
Okay, so now let's take the questions abroad, Now, what do you think about the US QE, the repurchase program, and the unlimited stimulus program? Since that the United States has the ultra high debt, and they got unlimited printing money. So what do you think will happen to the US market and how it will affect the local market?
Well, I think the US has to do that. The US is a very fortunate place because they are probably the only country in the world who can actually print money and get away with it. Because US dollar is a de facto trading currency. I mean, central banks all over the world, stash US dollar as reserves. Where else can you put your money in? So yeah, they have to print money and sort of get themselves out of the rut lah. Yeah, I think they should. They should do this QE thing. And what they did 10 years ago is really proven that it works. We're seeing such an amazing bull market in the US precisely because of the Fed's actions of doing this QE. And if they continue with it and confidence return, you're going to see a resumption of the bull market. In that sense, I agree with Derek. The bull market is probably going to come back if we get past this short recession, and there's a lot of liquidity in the US.
All right, so it's almost 10 o'clock. So let's just conclude today's session. So let me just share my screen. All right, so our next webinar is going on unleash the tactics of dissecting the technical charts. So it will happen on the 19th May in 2020. It's a Tuesday, not Thursday, okay, because it's a couple of days before the Raya. So it's happened 8:30 to 9:45. So you can click the link that I share in the chat group so that you can join our chat. Okay, so please go to our this link that I put in the chat group so that you can share. You can join our webinar in the May session. All right. So for those of you who want to open an account with Kenanga, please go to this link that I put in the chat group, www.kentrade.com.my/open-account-form. So that's where you can go online and submit an application to open an account with Kenanga. Okay? Yeah, so with that, I want to thank Mr. Cole for spending your wonderful evening with us to share about the research work, amazing work that Kenanga Investment Bank has done, so that all of us can participate in this, have a better idea on how we can buy in this market. Okay, what sector is underweight, what sector is overweight, so we have a clearer idea of what kind of industry we should go in. So with that, I want to wish all of you to have a wonderful, pleasant rest of the day. All right, and then stay safe in this lockdown. I was make known that there's additional 2 more weeks. So yeah, be safe, everybody. Thank you, Mr. Cole, and then bye, everybody.